Tom Lee to come to the phone. He's here with us now, of course, the head of research for FundStrat Global Advisors. Tom, welcome back. It's good to have you on the program today.
Yeah, thanks, Scott.
You know, when I see everything that's going on relative to the virus and otherwise, it seems like a difficult day to be recommending your so-called epicenter stocks, but that's what you continue to do. Why?
Well, Scott, you're right. I mean, you know, between now and Election Day, the market's in a tough spot because it can't look beyond that event. But the reason we feel comfortable sticking with the epicenter names is, number one, the virus is spreading in the U.S., but that outbreak is primarily in 30% of the country. You know, it's the states that didn't have an outbreak previously. So places like New York and Connecticut and Florida, they're still relatively benign rise in cases. And the second is the story of operating leverage. We highlighted how over 26 industries have posted either flat or even down revenue growth, but positive EBITDA in Q3. So in a restricted top-line environment, they've been posting growth in EBITDA, which means once we get past and this sort of huge bump around Election Day and we get stimulus, the 2021 earnings outlook is going to look really strong for these cyclical stocks. And, you know, as you get into November, people should be thinking about 2021. So it's a very tough spot. And, you know, we've been sticking with these things, and it's been really painful. But I still think that's the right way to tilt.
But, Tom, you're not going to get stimulus on November 4th, right? And you're not going to get a come down in virus cases on November 4th either. This virus is going to be raging into the fall and winter. That's not from me. That's from the experts, like Dr. Scott Gottlieb, who was on Squawk Box this morning, who says we're about to enter the most difficult phase of this whole thing.
That's right. I mean, I agree with, Dr. Gottlieb's really been speaking the truth throughout this crisis. And I agree. I think we are going through a third wave because, especially as the cooler weather, our immune systems aren't as strong. But what we think is really the scariest case is if the U.S. has to pursue a lockdown. That's what makes these stocks nervous. I just think we're not going to see New York City under a lockdown again, primarily because, a lot of New Yorkers and everybody in Florida and Texas, if you look at the surveys, mask compliance is in the 90s. So people understand the need to manage this risk. But it's really the states that have never experienced wave one and wave two and mask usage and mitigation aren't as prevalent. Those are the states experiencing these huge outbreaks. But once they sort of panic around that, I think that's why we don't have to worry about what's happening in Europe, which is, the risk of a huge shutdown.
Sure. But Tom, if I'm somebody who's concerned about the virus, I don't need my governor to shut everything down to get me to change my behavior or at least dial it back a little bit or not dial it forward at all. You hear what I'm saying, right?
Yep. Yeah. And Scott, what you're saying is, look, we could just get cautious and that's going to put a chill on everything. And to an extent, I think that is correct. I think that's what we should all do is be vigilant. But if we just stop going to restaurants, as a percentage of the economy, that's 1 or 2%. The real thing driving this economic momentum is people buying homes, people being able to safely go to school, which has been true, people able to keep businesses open, which has been true. But there are certain activities, as you're pointing out, that are not safe, and those are the ones that are going to get hit. But, for 40 or 50% of the S&P to take this hit, to me, that's an overreaction.
The other point you make that I want to discuss with you, which I'm not exactly sure what you mean in your note today, is that you say the Fed is going to intervene if there's a contested election, and that's more reason to be risk on. What's the Fed going to do?
Well, I think what I'm saying is the Fed and its role has sort of taken a step back in the market's narrative because we've been so focused on the election, and we really were hopeful that Washington could get a fiscal plan put together. And what will happen is if we have a contested election, I think the market is naturally going to say, wow, we're in huge trouble because we don't even know who's in charge of Washington, and fiscal could be delayed. But that's at the time when we think the Fed will, of course, step up again and provide the visibility. So I think for people who are going to be worried about a contested election scenario, they have to remember the Fed is still going to provide some sort of backstop role to protect markets and the economy. So I think what we're forgetting is that there's still this Fed put out there. It hasn't been important because COVID and the elections have dominated headlines, but the Fed is still out there.
Yeah.